Current market action for Plug Power Inc., ticker symbol PLUG. As of this exact moment, Plug Power is trading live at $2.18, down approximately 0.91% on the intraday session. We are seeing a slight pullback in early trading hours, with the stock oscillating in a tight range between $2.17 and $2.22. Volume is currently tracking at 41 million shares, which is slightly below the average daily volume, indicating a moment of hesitation or perhaps consolidation before the next major leg of movement. While the broader Nasdaq index attempts to find its footing, Plug Power is displaying a distinct decoupling from the wider tech sector today, moving less on macroeconomic tides and more on specific internal pressure points that we need to analyze immediately. The expectation right now, what you are likely hearing from every mainstream outlet and reading on every retail forum, is that Plug Power is a dead money trade. The common narrative suggests that the cash burn is insurmountable, that dilution is inevitable, and that the stock is destined to drift below the $2 mark and stay there. Investors are fatigued. They see the headlines about convertible debt offerings and assume the company is simply keeping the lights on. That is the expectation, a slow bleed into irrelevance. But here is the reality, and this is where the smart money is positioning itself while the crowd looks the other way. The reality is that underneath this chaotic price action, we are witnessing a massive structural pivot in how Plug Power operates, moving from a pure-play hydrogen gamble into a critical infrastructure provider for the data center and AI economy. While retail investors on the Robinhood app are selling out of frustration, institutional capital is quietly beginning to accumulate. Just recently, Manatuck Hill Partners disclosed a massive purchase of 2.5 million shares. You do not buy 2.5 million shares of a dying company. You buy them when you see a valuation dislocation that the rest of the market has missed. The reality is that Plug Power is sitting on a potential $1.66 billion Department of Energy loan facility that acts as a massive backstop, essentially a government-sanctioned floor that completely changes the bankruptcy thesis. The gap between the bankruptcy expectation and the strategic infrastructure reality is where the profit potential lives, and that is what we are going to tear apart today. Let's look closer at the immediate price action we're seeing right now at $2.18. The stock is testing a critical psychological support level. Technical traders using Interactive Brokers trading platforms are watching the $2.10 level like hawks. If you look at the level 2 data, there is a significant buy wall sitting just under $2.15. This tells us that despite the bearish sentiment, there is a dedicated buyer stepping in every time the price dips too low. This is not the behavior of a stock in free fall. This is the behavior of a stock in accumulation. It feels very similar to the early days of Tesla stock volatility, where the headline risk was always bankruptcy, while the underlying accumulation told a different story of future dominance. The intraday chart shows a series of lower highs, yes, but also higher lows over the last 48 hours. This compression pattern usually resolves in a violent breakout. The volatility we are seeing is shaking out the weak hands, the investors who bought on hype and are selling on fear. If you are using Schwab Intelligent Portfolios or similar automated tools, you might not see this granular data. But for active traders, this compression is a signal. It indicates that the selling pressure is exhausting itself. The bears are running out of shares to sell, and once that supply dries up, it takes very little buying pressure to send this stock ripping back towards the $2.50 resistance level. Comment below how many shares of Plug Power you currently hold and what your average cost basis is. I want to see if the majority of you are holding from the highs or if you have been averaging down during this consolidation phase. Now let's address the elephant in the room, the balance sheet. The fear of dilution is what keeps Robinhood stock trading forums up at night. Yes, Plug Power raised roughly $375 million via convertible notes recently. The expectation is that this is just more dilution. The reality is that this was a strategic refinancing move to pay off high-interest debt and clear the runway for the DOE loan closing. By swapping expensive debt for cheaper, longer-term capital, management is effectively buying time. Time is the most valuable asset for a growth company. It allows the Fidelity Investments and Fidelity Wealth Management divisions of the world to look at the books and see a path to solvency. When a company refinances debt, it is signaling that they believe their future cash flows will be strong enough to cover the obligations. It is a vote of confidence in their own execution, not a cry for help. We also need to talk about the shift in business focus because this is the specific catalyst that could catch the market off guard. For years, Plug was just the forklift company or the hydrogen truck company. That's a capital-intensive, low-margin business. The new reality is that Plug is pivoting hard towards stationary power for data center and AI economy. We all know NVIDIA stock has driven the AI narrative, but what does AI need more than chips? It needs power. Massive, uninterrupted, clean power. The grid can't handle the load that new data centers are demanding. Plug Power's hydrogen fuel cells are the perfect off-grid solution. They recently signed a letter of intent to monetize electricity rights and provide backup power for a major data center developer. This is the missing link. If Plug Power can successfully brand itself as an AI energy infrastructure play rather than just a hydrogen play, the valuation multiple expands dramatically. You go from trading like a heavy machinery company to trading like a tech infrastructure company. That is the re-rating event that SoFi investing users and retail traders are completely overlooking right now. If you were sitting there with your Fidelity mobile app open looking at the red numbers today, you need to understand the sector rotation that is happening. Capital is moving out of high-flying software names that have arguably topped out, and it is looking for value in beaten-down sectors that have policy support. Clean energy has been decimated over the last 2 years due to high interest rates, but interest rates are cyclical. As rates eventually stabilize or come down, capital-intensive growth stocks like Plug Power are the first to rip higher. It's the same dynamic we see with SoFi stocks or Robinhood crypto assets. When risk appetite returns, it floods into the assets that were sold off the hardest. Let's analyze the institutional landscape because this is often the best indicator of future price movement. We mentioned Manatuck Hill Partners, but look broader. Vanguard and BlackRock still hold significant positions. These firms don't gamble, they invest based on 10-year horizons. They are holding because the global shift to green hydrogen is not a matter of if, but when. Governments across Europe and the U.S. are mandating decarbonization. The U.S. government's $7 billion hydrogen hub program is rolling out. Plug Power is positioned to be a primary beneficiary of this public spending. When you invest through Fidelity brokerage accounts or Interactive Brokers accounts, you have to align your timeline with these government cycles, not the daily fluctuations of the Nasdaq. The expectation is that the hydrogen economy is too expensive and years away. The reality is that the cost curve is coming down faster than anticipated due to the Inflation Reduction Act subsidies. Plug Power is producing green hydrogen at its Georgia plant, and while they've had ramp-up issues, the fact that they're producing liquid hydrogen internally is a massive competitive moat. Most competitors are just assemblers. Plug is vertically integrated. They make the fuel, they make the engine, and they service the fleet. This this complete end-to-end ecosystem is what makes them sticky. Once a customer like Amazon or Walmart integrates Plug's infrastructure into their warehouses, it's incredibly difficult to rip it out. That stickiness is what creates long-term value. However, we must be objective and discuss the risks, because blind optimism is how you lose money. The short interest in Plug Power remains very high. Interactive Brokers stock trading data shows a high cost to borrow, meaning a lot of people are betting against this stock. If the company fails to close the DOE loan, or if they announce another massive at-the-market equity offering that dilutes shareholders by another 20%, the stock could easily test the $1.50 level. This is the danger zone. You have to watch the cash flow statements like a hawk. The company has promised a significant reduction in cash burn. If the next earnings report shows that burn increasing again, the market will be merciless. This is why using tools like Schwab Intelligent Portfolios or SoFi Robo-Advisor might be too passive for this specific stock. You need to be active. You need to be ready to pull the trigger if the thesis breaks. Let's talk about the